In today's video, we are breaking down a powerful interview with Dan Ives, Global Head of Tech Research at Wedbush Securities, where he explains why the software sector may be starting to bottom from current levels and why AI stocks are selling off even after massive earnings. Dan discussed the rough week for Nvidia, the latest funding round from OpenAI, and what all of this means for investors right now. I am going to play the clip of Dan Ives first, then I will come back and give you my own detailed reaction and breakdown of what he said. After that, I will walk you through an in-depth analysis of 3 undervalued stocks to buy now. Make sure to hit the like button, share the video, and let me know your thoughts in the comments. Subscribe to the channel so you do not miss the next important investing update. Now let's hear what Dan Ives has to say.
Welcome in, Dan Ives, on what's been Nvidia's no good, very bad week, despite an earnings report that wowed the street once again, including you personally and the way you covered this company. Couldn't throw any stones at this report, yet what gives with this bad week for this stock, and what does it mean then for how it might trade in the month ahead?
Yeah, Scott, I mean, it's a stunner, the way that this thing's traded here. I'd expect this is a stock that would actually be 210, 215. Look, this is, if you look from a report perspective, there's no way they could have done better. I mean, the $78 billion for next quarter, the $500 billion plus in terms of the pipeline, what we see with Blackwell and Rubin. I just think, in my opinion, this is as nervous as I've seen tech investors going back to last April. And we're in a sort of AI ghost narrative where good is bad, bad is worse. But I take a step back. I look at OpenAI with the funding round, check. You look at the data center revenue from Nvidia, check. I think software is going to start to bottom here, especially after the Anthropic event, Salesforce, ServiceNow, and others. So this is a turbulent period, but our thesis is unchanged. I'd say more bullish relative to the overall thesis.
Wow. I mean, I'll get to software in a minute because the prior few days had looked pretty good. Some people trying to call a bottom, today not so much. But I'll come back to that. The funding round that you and Kate Rooney were just talking about, I think immediately when I see the announcement, the fallout for a stock like Microsoft, which is not trading well, which hasn't traded well. What is the fallout?
Look, I mean, Microsoft, I think it's probably the most disconnected stock that I've seen in the last few years relative to where it's trading. Now, obviously, the view, like Amazon, others catching up. It's no longer just them in terms of that OpenAI relationship as well as what we see on the data center side. But look, my view is 10% of Azure customers have gone down the AI path. So as you actually look at this, it's going to be an incremental 25, 30 billion of revenue from Microsoft. It's just right now, it's a do not enter zone in terms of the view from investors. You're seeing them, you really head for the elevators in the name. But, Scott, as I've talked about, this is one of our top picks for the year, multiple years, because of where they play on enterprise, what Nadella is doing. In my view, OpenAI was essentially the training wheels for now what I think they're going to be able to do themselves. And I think numbers are significantly underestimated. It's a massive head scratcher at this sub 400.
Scratching your head, too, about Amazon. I mean, the stock barely getting a bump today. It's down more than 9% year to date. They seem to be, elbowing their way more heavily towards the front of the line of the arms race.
Yeah, look, I mean, Amazon's another one. If you look into some of the parts, you could say it's the most attractive it's been in probably the last 4 or 5 years. Jassy, everything he's doing, even on the OpenAI investment, you look at what I view from a data center perspective and acceleration we'll see in the next few years. I just think right now we are seeing a situation where all these stocks are getting thrown out. There's a view, obviously, Anthropic, Claude, as we've talked about in terms of the worries that's happening here in terms of the entrenched players. But our view is these are the times to look at who are the winners on chips, NVIDIA, AMD, Micron, the winners on the hyperscaler side, Microsoft, Amazon, others. And then you look what's happening in software. And I think we're going to look back, as brutal as this week's been, a horror show in terms of the nervousness, these will be the opportunities, given we follow the CapEx spending and ultimately where the spending is on the enterprise and AI. And that it will dictate where these stocks go over the next 12, 18, 24 months.
The interview starts with the elephant in the room, which is Nvidia having what Dan calls a no good, very bad week. This is what makes the situation so confusing for a lot of investors. NVIDIA just delivered an earnings report that, by almost every traditional metric, was phenomenal. Revenue guidance came in massive, the data center business is still exploding, and the AI pipeline numbers were staggering. Dan even says there was basically no way they could have done better from a report perspective. Yet the stock sold off anyway. That disconnect is really the heart of this entire conversation. Dan's explanation is not that NVIDIA did something wrong. His view is that tech investors right now are extremely nervous, more nervous than he has seen them since last April. We are in an environment where expectations have been pushed so far forward that good news does not move stocks higher anymore. Instead, it creates anxiety. In his words, we are in an AI goose narrative where good is bad and bad is worse. Personally, I think that is one of the most important lines in the entire interview. It perfectly captures the idea that the market is no longer reacting rationally to fundamentals, but emotionally to positioning and fear of being late. When Dan talks about NVIDIA specifically, he highlights the next quarter revenue outlook and the massive pipeline that stretches into the hundreds of billions. He also mentions upcoming platforms like Blackwell and Rubin, which reinforce that NVIDIA is not just riding a short-term wave but building a multi-year infrastructure backbone for AI. My own take here is that the market is treating NVIDIA like a trade instead of a business. When too many investors are on the same side of the boat, even great news can trigger selling simply because people want to lock in gains. Dan then zooms out and reminds viewers to step back and look at the broader AI ecosystem. He points to OpenAI and its funding round as a major checkmark that the AI build-out is still very real. He points to NVIDIA's data center revenue as another checkmark. From his perspective, these are not signs of a bubble popping, but signs of an industry still scaling aggressively. I agree with this part strongly. When you see this level of capital still flowing into AI infrastructure, it is very hard to argue that demand is suddenly disappearing. He then pivots to software, which is where things get interesting. Dan suggests that software stocks are starting to bottom, especially after what he refers to as the Anthropic event. He mentions names like Salesforce and ServiceNow as part of that potential bottoming process. My own opinion here is a bit more cautious. I do think software will benefit from AI, but I also think investors are still trying to figure out which companies will actually monetize AI versus just talk about it. That uncertainty is why volatility is not going away anytime soon. The conversation then shifts to fallout, specifically how OpenAI's funding impacts Microsoft. Dan does not mince words here. He calls Microsoft one of the most disconnected stocks he has seen in years relative to where it is trading. Despite being deeply embedded in AI through Azure and OpenAI, the stock has struggled. Dan argues that only about 10% of Azure customers have even gone down the AI path so far. That means the revenue opportunity is still largely untapped, potentially adding tens of billions in incremental revenue over time. What really stands out is Dan's conviction that Microsoft remains a top pick not just for this year, but for multiple years. He praises what Satya Nadella is doing and suggests that OpenAI was essentially training wheels for Microsoft's own AI ambitions. This is where I personally agree with him the most. Microsoft is not just an AI hype story. It is deeply embedded in enterprise workflows, and once AI becomes standardized inside those environments, switching costs will be enormous. At the same time, Dan acknowledges that right now Microsoft is in what he calls a do-not-enter zone from an investor sentiment perspective. People are heading for the exits, not because the story is broken, but because fear has taken over. In my view, this is exactly how long-term opportunities are created. The hardest time to buy is when nothing feels safe. The discussion then turns to Amazon, which has also been struggling despite its growing role in the AI arms race. Dan points out that if you look at Amazon as a sum of its parts, it may actually be as attractive as it has been in the last 4 or 5 years. He highlights the data center acceleration, cloud investments, and strategic positioning. Yet the stock barely reacts, which again points to the broader issue of investors throwing out anything associated with big tech and AI all at once. Dan wraps this part of the conversation by explaining that during moments like this, you need to identify who the real winners are. On the chip side, he names NVIDIA again along with AMD and Micron. On the hyperscaler side, he reiterates Microsoft and Amazon. His belief is that as brutal as this week has been, these periods of extreme nervousness often look like opportunities in hindsight. My overall takeaway from this interview is that Dan Ives is not ignoring the volatility or pretending everything is fine. He is acknowledging the fear while also reminding investors to anchor themselves in fundamentals and long-term trends. I personally think this interview is less about specific stock picks and more about understanding where we are in the emotional cycle of the AI trade. When great earnings lead to sell-offs, it usually says more about sentiment than reality. If there is one thing I would slightly push back on, it is the idea that the bottom is imminent across software and hyperscalers. I think we are closer to the middle of a digestion phase than the end of it. But I also agree with Dan that this is not the end of the AI story. If anything, it is the market forcing investors to separate real execution from hype. And historically, that process is painful, confusing, and often rewarding for those who can stay patient. Now let's jump into 3 of the most undervalued stocks on the market right now that represent real long-term opportunities with durable competitive advantages and massive future growth potential. The first undervalued stock on this list, a company that touches the lives of millions of people every single day and quietly operates one of the most powerful business models in the entire market. United Health Group, ticker symbol UNH, is not just an insurance company. That is the first misconception investors need to move past. United Health is a vertically integrated healthcare platform that combines insurance, healthcare services, data analytics, and technology into a single ecosystem. This structure gives it visibility and control across the entire healthcare value chain in a way very few companies can match. At its core, United Health operates through 2 major segments. The first is United Healthcare, which provides health insurance coverage to individuals, employers, and government programs. The second, and increasingly more important segment, is Optum. Optum is the engine that transforms United Health from a traditional insurer into a healthcare services and data powerhouse. Optum includes pharmacy benefit management, healthcare delivery, analytics, and technology platforms that help manage costs and improve outcomes. Why does this matter? Because healthcare is fundamentally broken when it comes to cost efficiency, transparency, and coordination. United Health sits in a position where it can identify inefficiencies, manage risk, and use data to drive better decision-making at scale. That is not just a competitive advantage, it is a structural moat that becomes stronger as the system becomes more complex. One of the reasons United Health is currently undervalued is investor concern around regulatory and political scrutiny, particularly related to Medicare Advantage reimbursement practices. Headlines around investigations and potential changes to payment models have created fear that profitability could be pressured. While these risks are real, the market reaction has arguably gone too far in discounting the long-term earnings power of the business. What investors often miss is that United Health has navigated regulatory scrutiny for decades. Healthcare is one of the most regulated industries in the world, and United Health has built its business knowing that rules evolve. The company has the scale, legal resources, and operational flexibility to adapt. More importantly, even under more conservative reimbursement scenarios, United Health continues to generate strong cash flows and earnings growth. Another key point is the diversification of revenue streams. United Health is not reliant on a single government program or customer base. It serves employers, individuals, and public sector programs while simultaneously expanding Optum's services to third parties, including competitors. That diversification reduces risk and smooths earnings across economic cycles. From a financial perspective, United Health consistently delivers revenue growth, strong margins, and robust free cash flow. These are the characteristics of a high-quality compounder. Yet the stock trades at a valuation that suggests skepticism rather than confidence. Forward valuation metrics sit below what investors have historically been willing to pay for a business of this quality and stability. This disconnect creates opportunity. When a company with a wide moat, predictable demand, and long-term growth drivers trades at a discounted valuation, it often reflects short-term fear rather than permanent impairment. Healthcare demand does not disappear. If anything, demographic trends such as an aging population and increased chronic disease prevalence support sustained growth in healthcare services. Optum deserves special attention here because it is arguably the crown jewel of United Health. Optum's data and analytics capabilities allow the company to manage care more efficiently and proactively. This not only improves outcomes but also lowers costs, which is exactly what employers and governments want. As healthcare systems increasingly move toward value-based care models, Optum's capabilities become even more valuable. Investors who focus only on insurance margins miss the broader picture. United Health is positioning itself as a healthcare infrastructure provider, not just a payer. That distinction matters for long-term valuation because services and technology businesses often command higher multiples due to scalability and margin potential. There is also an underappreciated element of switching costs. Large employers and government programs do not easily switch healthcare providers. The complexity of coverage, data integration, and service delivery creates stickiness that protects United Health's market position. Once embedded, these relationships tend to last for years. When you combine all of this, the investment case becomes clear. United Health is a dominant player in an essential industry with a diversified revenue base, strong cash generation, and long-term growth drivers. The current valuation reflects uncertainty rather than fundamentals. For long-term investors, that gap between perception and reality is where returns are made. Now is a good moment to pause and recognize that opportunities like this are rarely comfortable. Buying a stock when headlines are negative and sentiment is weak requires conviction, but historically, that discomfort has often been the price of admission for outsized long-term gains. Before we move on to the next stock, here's a quick message from our sponsor. This video is brought to you by Value Stocks Investing Master Course. If you are looking to grow your wealth by investing in solid, undervalued stocks, but not sure where to start, I created the Value Stocks Investing Master Course to teach you how to identify great companies, make smart investment decisions, and build a portfolio that lasts. Click the link in the description and pinned comments to get the course today and take control of your financial future. The second undervalued stock on this list is Qualcomm, ticker symbol QCOM. To understand why Qualcomm matters, you have to stop thinking about consumer gadgets and start thinking about connectivity as a global utility. Qualcomm sits at the core of that utility. Its technologies make it possible for smartphones, vehicles, industrial machines, and connected devices to communicate reliably and efficiently. In many ways, Qualcomm is not just a chip company. It is an intellectual property and platform company that enables entire ecosystems to function. For decades, Qualcomm has been synonymous with wireless standards. From early mobile networks to today's 5G infrastructure, Qualcomm has consistently been at the forefront of developing the technologies that define how devices connect. This leadership position did not happen by accident. It is the result of sustained investment in research and development, combined with a deep portfolio of patents that competitors must license in order to operate in the wireless space. That patent portfolio is one of Qualcomm's most powerful competitive advantages. Unlike many semiconductor companies that rely purely on product sales, Qualcomm generates significant recurring revenue through licensing. When manufacturers build devices that use Qualcomm's patented technologies, they pay royalties. This creates a high-margin, cash-generative revenue stream that is less volatile than hardware sales alone. Despite this, Qualcomm stock has often been treated by the market as a cyclical hardware play tied primarily to smartphone demand. When global smartphone shipments slow, investors tend to extrapolate that weakness forward and discount the stock aggressively. That is exactly what has happened in recent periods, creating a valuation gap between Qualcomm's market price and its long-term earnings power. What the market often overlooks is that Qualcomm has been deliberately diversifying its business away from reliance on smartphones. While mobile still matters, it is no longer the sole driver of the company's future. Qualcomm has been expanding into automotive, industrial IoT, edge computing, and connected devices across multiple sectors. The automotive segment is particularly important. Modern vehicles are becoming rolling computers, packed with sensors, connectivity modules, and increasingly sophisticated software. Qualcomm's Snapdragon platforms are being integrated into infotainment systems, advanced driver assistance features, and vehicle connectivity solutions. As the automotive industry continues its transition towards software-defined vehicles, Qualcomm is positioned to capture long-term growth that extends well beyond any single product cycle. Another critical area is the Internet of Things. Factories, cities, homes, and infrastructure are becoming more connected every year. Qualcomm provides the chips and connectivity solutions that allow these systems to operate efficiently at scale. Unlike consumer electronics, these deployments tend to be long-lived and embedded deeply into operations, creating sticky customer relationships and predictable demand. From a strategic perspective, Qualcomm's role in setting wireless standards gives it leverage that few companies possess. As new generations of connectivity are developed, Qualcomm is not just reacting to change, it is shaping it. This ensures that its intellectual property remains relevant and monetizable as technology evolves. Financially, Qualcomm remains a strong cash generator. Even during periods of demand softness, the company produces substantial free cash flow. This cash supports dividends, share repurchases, and continued investment in future technologies. For long-term investors, that combination of income and reinvestment capability is a powerful driver of compounding returns. The current valuation of Qualcomm reflects pessimism about near-term demand cycles rather than the durability of its business model. Forward earnings multiples and free cash flow yields suggest the market is pricing in a prolonged slowdown or structural decline that is not supported by the company's strategic positioning. This disconnect is precisely why Qualcomm appears on the list of undervalued stocks to buy now. It is also important to consider the global context. Connectivity demand does not disappear, it evolves. Emerging markets continue to adopt smartphones and connected devices. Developed markets upgrade networks and infrastructure. New applications such as autonomous systems, industrial automation, and edge AI increase the need for efficient wireless solutions. Qualcomm sits at the intersection of all of these trends. Another underappreciated factor is switching costs. Device manufacturers design products around specific chip architectures and platforms. Once a platform is chosen, switching suppliers is not trivial. This creates stickiness and long-term relationships that protect Qualcomm's market share even as competition increases. Investors who focus solely on short-term shipment numbers risk missing the broader arc of the story. Qualcomm is not a one-cycle company. It is a long-cycle enabler of connectivity that benefits from secular trends that unfold over decades rather than quarters. From a risk perspective, no investment is without uncertainty. Regulatory pressures, geopolitical tensions, and competition all exist. However, Qualcomm has demonstrated an ability to navigate complex environments over time. Its diversified revenue streams, global customer base, and deep intellectual property portfolio provide resilience that many smaller competitors lack. When you step back and look at the full picture, Qualcomm represents a classic value opportunity within the technology sector. It is a high-quality business with durable advantages trading at a valuation that implies skepticism about its future relevance. History suggests that companies with this profile often outperform when sentiment eventually catches up to fundamentals. This brings us to an important theme that connects the first two stocks discussed so far. In both cases, the market is focused on near-term concerns and headline risks, while underestimating the staying power and adaptability of businesses that operate critical infrastructure. Healthcare delivery and wireless connectivity are not optional services. They are embedded in modern life. The final stock on this list, and arguably the most widely recognized, yet still one of the most misunderstood by the market when it comes to long-term value creation. This is a company that operates at enormous scale, touches multiple parts of the global economy, and has built infrastructure that would be nearly impossible to replicate today. The third undervalued stock to buy now is Amazon, ticker symbol AMZN. To understand why Amazon belongs on a list of undervalued stocks, you have to move past the simplistic view of it as just an online retailer. Retail is only one layer of Amazon's business, and in many ways it is the least important when it comes to long-term value. Amazon is better understood as a global infrastructure company that spans commerce, logistics, cloud computing, and increasingly artificial intelligence. Let us start with what truly sets Amazon apart, which is its scale and integration. Over the past 2 decades, Amazon has invested hundreds of billions of dollars into building a logistics and fulfillment network that spans warehouses, transportation, last-mile delivery, and automation. This network is not just large, it is deeply optimized through data, software, and operational learning that improves with every order processed. This matters because logistics is one of the biggest barriers to entry in commerce. Any competitor that wants to challenge Amazon at scale would need to invest enormous capital for many years before reaching comparable efficiency. That creates a structural moat. Amazon can deliver faster, more reliably, and often at lower marginal cost than most competitors, especially as volume increases. For years, investors criticized Amazon for low retail margins and heavy reinvestment. What those critics missed is that Amazon was deliberately building long-term infrastructure at the expense of short-term profits. Today, that infrastructure allows Amazon to extract efficiencies, improve margins, and turn what was once viewed as a cost center into a competitive weapon. At the same time, retail is no longer the primary driver of Amazon's valuation. That role belongs to Amazon Web Services, or AWS. AWS is the largest cloud computing platform in the world and one of the most profitable segments within Amazon. It provides computing power, storage, databases, and advanced services to startups, enterprises, and governments globally. AWS matters because cloud computing is foundational to the modern digital economy. As companies move workloads from on-premises systems to the cloud, they rely on platforms like AWS to scale, secure, and manage their operations. This creates recurring revenue, high switching costs, and long-term customer relationships. What makes AWS particularly powerful is its position at the center of artificial intelligence deployment. Training and running AI models requires massive computing resources. AWS provides the infrastructure that makes this possible. As AI adoption accelerates across industries, demand for cloud infrastructure grows alongside it. This links Amazon's future directly to one of the most significant technological shifts of our time. Financially, AWS generates strong operating margins and substantial cash flow. This cash supports Amazon's ability to invest elsewhere in the business while still improving overall profitability. In recent periods, AWS growth has re-accelerated, signaling that enterprise demand for cloud and AI infrastructure remains robust despite macro uncertainty. Another underappreciated aspect of Amazon's business is advertising. Amazon has quietly built one of the largest digital advertising platforms in the world by monetizing product search and placement within its ecosystem. Brands pay for visibility at the point of purchase, which is extremely valuable. Advertising carries high margins and benefits directly from the scale of Amazon's retail traffic. When you combine retail, logistics, cloud computing, and advertising, you get a diversified business model with multiple engines of growth. Few companies in the world have that level of breadth and optionality. This diversification also reduces risk because weakness in one segment can be offset by strength in another. So why is Amazon considered undervalued right now? The answer lies in market sentiment and near-term focus. Investors have been concerned about slowing growth, margin pressures, and the impact of macroeconomic conditions on consumer spending. While these factors matter in the short term, they do not fundamentally change the long-term trajectory of Amazon's core businesses. At current valuation levels, the market appears to be discounting Amazon as a mature company with limited growth. That view ignores the ongoing expansion of AWS, the monetization of advertising, and continued efficiency gains in logistics. When you factor in these drivers, Amazon's long-term cash flow potential looks significantly stronger than what the stock price implies. There is also an element of underestimation when it comes to management discipline. In recent years, Amazon has shown a greater focus on cost control and return on invested capital. This does not mean innovation has slowed. It means the company is entering a phase where its massive investments are beginning to pay off in a more visible way. From a competitive standpoint, Amazon benefits from network effects across its ecosystem. More customers attract more sellers. More sellers increase selection and improve pricing. More transactions generate more data, which improves recommendations, logistics planning, and advertising targeting. This flywheel effect is difficult to disrupt once it reaches sufficient scale. For long-term investors, Amazon represents ownership in critical digital infrastructure rather than a single product or service. As commerce, cloud computing, and AI continue to expand, Amazon is positioned to capture value across multiple layers of that growth. When you step back and compare all three stocks discussed in this video, a clear pattern emerges. United Health Group dominates healthcare infrastructure and data-driven services. Qualcomm controls critical connectivity technology that enables the digital world. Amazon operates the platforms and infrastructure that power commerce and cloud computing. These are not optional businesses. They are embedded deeply into modern society. If you want exclusive stock tips, in-depth analysis, real-time trade alerts, and free investing guides, join the StocksGalore Patreon today and take your investing game to the next level. Our members get full in-depth analysis on most of the stocks mentioned here. Head over to patreon.com/StocksGalore and become part of our growing community of smart investors. Link is in the description. Now I want to hear from you. Looking at these three businesses, which one do you believe has the strongest long-term competitive advantage over the next 10 years, and why? Is it the healthcare infrastructure of United Health Group, the connectivity mode of Qualcomm, or the global digital ecosystem built by Amazon? Share your thoughts in the comments and let us know how you are thinking about long-term investing. Do not forget to like the video, share your thoughts in the comments, and subscribe so you do not miss the next important investing update. Thanks for watching, and I will see you in the next one.